Thank you, everyone, for being here to our intermediary panel. Today, we have an esteemed panel that is going to be led by Kevin Chiappetta to talk about how our managers that are looking at ESG are managing their portfolios, and what I was told could be a little bit of a heated debate enthusiastic debate. So very much looking forward to it. It's fun to be back at Marquette. I'm a 2008 graduate of the business school doing the applied program. I have some intersections across the way. After school, I went to Baird, and I've been there for the last 14 years, having been on the allocator side, doing due diligence onto ESG ETF managers for a while, as well as individual stocks, now overseeing investor relations, fundraising, and marketing for our private investment area. So we are doing more of the ESG strategy, and it's been incredible for the past 14, 15 years since I graduated, how ESG has gone from something for ex-hippies and clean and green millennials to now mainstream. So very excited to be here at Marquette and introduce this panel. With that, we have our moderator for today, Kevin Chiappetta, who is the president of the CFA Society of Milwaukee. We also have, and I will do in no particular order, actually I'll try to do in the right order, Bob Smith, our president and CIO of Sage Advisory. We have Leo Harmon, the senior managing director and CIO of equity management at Mizero. We have Mike Klein, managing director of our private asset management at Baird. And then on the screen, we have Glenn Yelton, head of ESG for Invesco. And with that, I'll turn it over to Kevin.
Thank you, Katie. When I was asked to come and moderate the panel, I did a little research and I found out, some of you heard earlier how much work Chris does for the program here at Marquette. And my understanding is that Chris's mission in finding a moderator is to find the person in Milwaukee who knows the least about ESG investing. And he went to it, and I have to say he hit that one out of the park as well. So with that, for the panel, I may or may not, depending on how this goes, have to challenge and help define. And I'd like everybody to speak as though you're talking to somebody who is maybe 12, 13 years old on this, because that's about the knowledge that I'm bringing to the table. So if you could just, to begin with, maybe just humor me a little bit, and we'll start, let's start with Mike at the far end, and just maybe explain a little bit about what you do for the group, and tell me how your daily work touches the ESG topic. What is it you do specifically to focus on ESG?
Sure. I run the asset management division, the consulting area for Baird. And we find ourselves educators at this point. In fact, Chris, who is running the program, actually is one of our group. And what we've been finding in terms of ESG over the last 10 years is both our clients, who are the foundations, the universities, the pensions, went from really having little or no knowledge or no desire to wanting to have an impact, and most of the time not knowing what that is. And we end up educating them on where and how, and how to put something in place that's actually workable and sustainable. At the same time, we work with the asset managers. So we're working with the various suppliers we find, the index funds, the different money managers, and we are working with them to either craft a strategy, work with their investments to modify them, or if it's a plug-and-play strategy, we're actually screening those investments and trying to figure out and doing the interviewing and using a combination of outside databases and internal data to put together strategies that we can plug in for these people. So we find ourselves doing more and more of this, and it is a daily conversation, and it is becoming more so as we are progressing down this road.
Okay, thanks, Leo. I'm going to give you the same question.
Yeah, I think I would concur. My team manages small and mid-cap equity assets. We have, I want to say I got my first question, or saw my first question related to ESG on an RFP around 2009. And probably since that time have been more focused on it as a group, particularly on the governance side, and integrating that into our investment process for a long time. We've always thought about ESG as really being a fourth pillar of factors of investing. If we look at, quality, growth, and value, ESG was always a part of that. More recently, really at the prodding of customers, we were challenged to start a sustainable-only product, and really focused our efforts in trying to create not only a product, but a process that we thought would be viable within the sustainable space. And so we continue to evolve in that fashion as we get more and more flavors of ESG and more inquiries from clients to create products that meet their needs.
And we're going to come back and get a little bit in depth as to what those are, assuming we have time, but I'd like to give Bob a chance to maybe address the question too. Where are you in the ESG world?
Yeah, good afternoon, everyone. I would say that Sage Advisory is a little bit different in the sense that we started on the fixed income side of the business. Our focus is primarily on everything from cash management going all the way out to core plus fixed income. We do taxable and tax exempt ESG optimized portfolios. And we're also working on the ETF side of the business. I think we have one of the longest track records for, as a strategist, and ESG optimized equity strategy that's on Morningstar. We have one on core plus fixed as well. And what we try to do is to utilize not only our knowledge and our research that we do on ESG in terms of the optimized product, but also in the conventional product in a very large way. Is becoming increasingly apparent that non-ESG optimized products actually are being driven more and more by ESG considerations and ESG research factors. And we're finding it easier and easier to bring it to the attention of our clients. Problem is, reporting it to them is really, really difficult. Having vignettes and little bitty stories about how this company is better than that company doesn't necessarily stick, and I think positive reinforcement is really necessary. So about 4.5 years ago, we created our own rating system known as our LEAF score. It's a very simple 1 through 5. We apply it to every CUSIP in every portfolio. I don't know of anybody else that does that at the moment. It's difficult to do, but we utilize information that we generate internally. We use Arabesque, we use MSCI, Sustainalytics, all of them, but we really come up with, using their data, our opinion. And I think that's an important distinction in today's market. Is it your opinion, or is it MSCI's opinion that you merely layered over your portfolio? I think that's a real distinction that's worth talking about, particularly when you're trying to figure out one manager versus another. And that's kind of where we think, the next part of our journey is going to go. Clients need to see it to believe it. Most of them, I think, come from Missouri most days. But the fact is that we're not doing a good enough job as an industry in reporting that on a month-to-month basis. We talk about it. We don't show it very well. And then I think the last part that's going to have to be worked on is the outcome analysis, the proof of the pudding. How do we report that to clients? What do they need to see? How do we get that point across, that their positive inclinations are turning out to be positive impacts that are enduring? And so those are things that we're kind of kicking around in terms of how do we get this point across to our clients.
All right, there's a lot to chew on there in a second here, but before we get that, Glenn, I'd like to give you your opportunity now. Can you just move a little to your right and cover up that Chelsea banner for me a little bit? Thank you.
No. I've got to have that Chelsea banner out there. Champions of Europe right now. But to follow up here, so my role at Invesco, I've been in this space for 21 years now. So I've seen the evolution of what was considered SRI to ESG and all the flavors that have came along. And my role today at Invesco is to do a couple of things. One, I'm a myth buster because there are a lot of myths about ESG. And Michael, you sort of hit on this with the education piece. We have to help people understand what you can and can't do and what the myths are about performance, about its impact on portfolio construction, about the data itself. And Bob, you caught a little bit of that. It's not a completely comprehensive data universe. The second role that I have with Invesco is being a pragmatist. ESG is not for everybody. There are different competing priorities that we have among our clients. Some really are focused on returns, and ESG and some asset classes, whether we like it or not, can impede the best investment returns. And finally, being very much the realist in the room. It's an incomplete data set. The S&P 500 last year, over 85% of the S&P 500 voluntarily disclosed E&S data. It's an amazing amount, right? Over 85% of the largest publicly traded companies in the U.S. Back whenever I started, it was less than 15%. But the reality is that means that almost 15% of the largest publicly traded companies in the United States in 2021 still don't voluntarily disclose E&S data. We need to be realist about that. We need to understand the impact that it has on portfolio construction, on how we look at ESG factors and how we integrate that into our investment decision-making process. And Bob, you keyed in on a little bit of that. It's also about being realist about whose opinion you're actually relying on. And hopefully we'll unpack some of that in our lively panel today.
And thanks for that. I want to start a little bit at a higher level. So Mike, I'm going to come back to you, and maybe you can help people like myself who may not even know what questions to ask. How do we help investors focus into ESG? I mean, what can you do to maybe fine tune some broad, whether they be misconceptions or just no perception whatsoever? How can you help us focus in and find some of those key factors so we can eliminate some of these mistakes that we're hearing allusions to so far?
Well, no, I think that's exactly right. And your comment that whether it's no perception whatsoever, I think every investor that comes to us now has some kind of perception. All right, they do. They whether they think it's going to be a zero carbon portfolio or they've heard two different terminology. The biggest thing that we have, and I will say we've got an excellent staff, and some of our staff is sitting out in the audience right now. They really are excellent practitioners in truly sitting down and dispelling. I go along the lines with the myth. All right, that the ESG portfolio is going to have bad returns. That we're going to, that this data is so perfect and so pure that if one's got a different number, or Morningstar says this, or ISG says this, that we can't use this, ISS says that. And so we need to bring it back and say this is really more of an art at this point, but the outcomes can still be, it can still have a very positive effect on outcomes. And so we start out with the fact that our clients are here to we're here to invest our money. We're here to get them a return at the end of the day. We're here to get them a return at a very cost-competitive methodology. The last thing we try to do during that journey is take their goals and frankly their ideas and as it relates to ESG, break that down for them in terms of what this actually means, the definition of each piece of the ESG, and work backwards in terms of what's really important to you. Now, one thing that we have found is that we rate every one of our portfolios. And we use a very similar methodology of taking multiple data sources and then putting an opinion over them. And we do that for a reason, because what we have found is that our returns, the companies that follow good ESG practices are typically well managed. They're more thoughtful. All right. We've heard all the comments. Well, this one's doing a better job on water, and this one's doing a better job on carbon, on reducing carbon, and reducing their cost. Human capital. Okay. Biggest problem we're having right now, we're talking about water, is human capital, the turnover in staff. All those factors go in, and the better those our companies rate, we tend to find out that they actually perform better. And so it's sitting down and taking the time, especially when we end up dealing with a lot of boards, and you end up with 5, 6 different people, each one with a different opinion, and you do have to break it down to the basics. And that typically is a good starting point. Then realizing that this being an art form, we're not going to be using these guidelines as strict buys and sells. We're going to be using them as guidance. We want the company to be in this range. We want our portfolio to be in the upper half, in the upper quartile. But we're not looking to find the best. Well, yeah, we're looking to look at companies that are trending properly, even dispelling the idea with clients that we can't have any energy-related companies. This is a journey. Okay, we need power, we need energy, we need fuel, but let's get companies that are well managed, doing the best job of sustainability, and are improving their platform along the way, as opposed to just saying we can't have this. It doesn't. And we find that almost all clients are very receptive to that. We have very little pushback once given the time to do the educational portion of it.
Okay. Leo, I'm going to come back to you with a slightly different aspect on that, because I know you were calculating the same answer to that same question, so I'm going to throw it off a little bit. Help me understand your firm. What measurable exposures might you be able to describe for us? Not just what the exposures are, but how do I measure that as it relates to ESG?
Well, I think we're all looking at sort of the same sets of data, or at least sort of the same sets of data from firms. Glenn talked a little bit about sort of standardization and the number of companies that are reporting. Within the small cap space is even worse. So we're looking at companies within a Russell 2000 or Russell 2500. Most of those companies are just trying to keep the lights on and trying to grow and don't pay a lot of attention, or may not pay a lot of attention to the importance of disclosure. And so we spend a lot of time really engaging with those firms, trying to collect data and collect measurables that we think are at least apple to apples, so that we can try to build best-in-class portfolios. We have clients that will run the spectrum. So you talked about how do you talk to your clients? Well, sometimes it depends on what the client wants. We have clients that are religious and SRI portfolio on the far end of this spectrum. We have other clients who are only concerned about return and only want ESG as far as it impacts materiality. And you have to be able to explain to those clients all of the trade-offs that happen from one end of this spectrum to the other, regardless of what their needs are. And so we try to create measurables that we think are apples to apples. We try to create comparables across the portfolio. I think, as Bob alluded to, it's very important to understand that you have a data set, but you need to have your own opinion as it relates to that data set. And probably, particularly in the small cap space, do your own research as it relates to how those companies are matriculating along their own curve of sustainability, so that you can get an assessment of what the rate of change is, what the impact is, and how much they can impact their company, either from a risk or return standpoint, both positively and negatively.
Okay. So I'm going to save this for both Bob and for Glenn. I'm going to take a slightly different track now. Let's talk about performance and measurement of performance. When we talk about performance, do you have to change your performance standards? Do we have different measurables? Do we have? I mean, what is my unit of measure? What is my benchmark? I'm going to always start with the fixed income guy, being a fixed income guy. So Bob, I'm going to let you start on that. Tell me how performance for ESG might differ from the performance we're more traditionally brought up with.
Well, I think to some extent that's the rub, isn't it? That it doesn't measure up. So, we are always going to run our ESG optimized portfolios relative to a conventional benchmark. Just to show that it absolutely does hold water and it is competitive and it gets the job done. The question is degree, how? And so for us, the standards, are what the market sets. And if the market says, look, I want to run against the ag, or I want to run against this, that, or the other thing, fine. Then we will show you what we can do from a conventional comparison standpoint. Because you don't want to take people too far away from where their comfort zone is. That's the first thing. Second thing is that I find that there's a lot of creativity in benchmarks that are being created now by a variety of different benchmark manufacturers that are the best ESG benchmark. And there isn't enough time in the day to sit down and tear them all apart. and say, well, is this benchmark, this ESG optimized benchmark better than that one, better than this guy's, and so forth. And so we don't deviate too far off where we think the comfort zone of the average client is in terms of how to understand the market. And I think that's a very important distinction. Now, where it can get a little rough, and I think Leo pointed it out, gets a little bit rocky and rolly, is away from the S&P 500. And you sit down and think about it, you look at the Russell 1000, only 39% of the Russell 1000, okay, actually produces an annual CSR, whereas 90% of the S&P 500 does. It's a huge difference. Leo's got a tough job. How do I figure this out, okay? It isn't easy. And so, again, I think getting back to standards, in order for ESG to essentially put down the constant rejoinder of, you know, it doesn't perform, it's going to cost performance and so forth, I think you have to be able to go out there and show people that it does compete head-on with the conventional product. Otherwise, you'll always have that cloud of doubt behind you.
Fair enough. And would you say that there may be a secondary reporting as it relates to performance, perform against a more traditional benchmark and maybe a more environmental or a more societal benchmark?
The more important one, which is what the SEC is going to come gunning for, is the greenwasher. And, you know, the pretender, the Pinocchio in the crowd, okay? The fact of the matter is that the SEC is going to look at your performance and say, that's great. Let's look at your ESG characteristics and what you claim is in your portfolio. Show us those metrics. Show us those standards. Show us how you compare versus other market indexes on the same basis. And if you can't show up well, or you're making claims that cannot be substantiated and well demonstrated, the walk of shame is ahead of you. It's that simple. That's what's coming.
Thank you. Glenn, I'm going to come to you with a similar question. I can feel the tension waiting from you, but I'll say one of the few things I remember from my CFA studies on benchmarking specifically is that you need to specify it in advance, which I found out was, I always thought at the time was one of the most ridiculous things to have to put in writing, but apparently one does have to put that in writing. So if you could maybe address that more, maybe from your equity perspective, or if you need to echo the similar responses, that's fine too.
Yeah, well, Bob hit a lot of it right on the nail right on the head, because an ESG product needs to be benchmarked against a conventional equivalent benchmark, right? It can't be an esoteric instrument. It can't be a bespoke where they mix and match. Because you let me dial in all the flavors to make my product look best against some custom index. You know, it's always going to look great, right? Cannot be that. That's the greenwashing, and that's, Bob, you're right on, spot on right there. That greenwashing, that walk of shame. The way that you avoid that is by benchmarking against a conventional index, a conventional equivalent. That also means that your risk metrics that you're first applying to an ESG portfolio, they need to be the same risk metrics that you apply across all of your portfolios. It's your sector allocation, your difference from the index in that. It's your beta, your Sharpe ratio, all your traditional. Those are the fundamental risk metrics that an ESG portfolio has to be measured on. The secondary is the attributes related to whether you are specifying out particular ESG behaviors. And this is where we need to delineate between the concept of ESG integration versus something that is a labeled ESG product. And ESG integration is about looking at material and relevant ESG factors in the investment decision-making process. And frankly, a good analyst, a good portfolio manager should already do that. Leo's doing that in small cap right now, right? That's how you sort of, it's that asymmetrical information environment that you can operate in small cap. That's pulling in those factors to make an investment decision. That's different than a labeled ESG product, though. A labeled ESG product, I'm saying I'm net zero. I'm lower carbon emissions. I'm focusing on gender lens investing. And in that case, there is a secondary set of reporting and metrics that need to be evaluated. And again, Bob, to your point, that needs to be how you deviate, your delta and an improvement from a non-ESG benchmark. How much more diverse is my C-suite and my board if I'm doing something that's focused on DE&I? What's my net carbon emissions, scope 1, scope 2, scope 3, if I'm looking at a low carbon? What's my transition pathway if I'm looking at net zero? That's where you delineate and deviate from that standard benchmark, is just looking at those ESG metrics. That's a new factor that you're introducing there. But that's the truth in the story, and I think we'll unpack the truth in the story a little bit more as we go through the panel today, though.
Before I go on to my next question, I want to make sure anybody in the audience, when you would get a chance at these people, now might be your only chance before we've got better places to be.
You should have given them the cocktails first. Then we would have a more.
If there's a
amenable
suggestion box
audience.
out back, I'll let them know.
What about tracking error? Not necessarily just performance, short-term tracking error.
Related to the benchmark or related to other traditional products?
Factor, do you expect higher tracking error?
I think it depends on what you're doing with your product set. So we have a traditional product that incorporates ESG, that we're looking at ESG as a factor for investing that we think can drive risk down or drive returns higher. We also have a sustainable product that is ESG focused, where we're looking to benchmark against other ESG related products in a normal benchmark, where we have environmental and social factors that we think are favorable versus that benchmark. Those are going to deviate a little bit over time, but it's the same philosophy, it's the same process, it's the same risk metrics, it's the same engagement process with those companies. So if you're doing this correctly, your tracking error relative to a benchmark over time should not be that different. Your performance over time shouldn't necessarily be that different, because you're incorporating a lot of the same parameters within both, at least from my perspective, both your traditional and your sustainable products.
No, I would agree. I mean, if you're just doing an overlay and you have an ESG overlay on top of your product, it should track relatively close to a traditional benchmark, within reason. But if you have an extreme set of criteria that you're managing to, extremely low carbon or an SRI, for an example, then you are going to have your deviation. But then you're also, in part of the initial process of working with that client, you're going to give them a second set of matrix, and those matrix are going to show them, to the point brought up before, how their portfolio benchmarks against traditional benchmark, not in return, but in construction of those criteria that you're trying to work away from.
I would agree in the sense that, tracking error is important in the sense that you can't be too far off the mark of the conventional product. We're on a variety of different wrap platforms. Dispersion is always important. Tracking is always important, whether it's the ESG integrated product or whether it's the conventional product. And we happen to have, an intermediate fixed conventional versus ESG, integrated 100%. And, that's just the way the client wants it, in the sense I want two different flavors here. But the fact of the matter is, the month-to-month, quarter-to-quarter returns have to be pretty damn close to each other. If they start having these wild dispersion differences, this one's very closer, this one's out here, then there are going to be a lot of questions and a lot of issues with regard to, the advisors, the clients, and so forth. In terms of, this is not what I expected, because I thought this was going to be similar to the domestic in terms of tracking and dispersion and so forth across my accounts. And so we're always cognizant of that, so we have to manage to that. One of the biggest challenges probably has occurred in the last 12 months when you sit down and look at the energy complex in fixed income, and you look at what a big swing factor that was over the course of the last 12 months. And you have to recognize that and say, look, I'm going to have to battle against this in the conventional index. What are the other things that I can do to offset some of those moves that I anticipate as I run my models? Here's what I anticipate the differences to be between the two styles. What are other things that I can do to kind of offset that, because I can't make up an exposure in the energy component in the ESG optimized product. Mm-hmm. And so we're always studying kind of the mix and the match, if you will, to get the same general outcome as best we can without turning into something completely different than what the client might have expected. Does that make sense? Hope it does.
And actually, if I can continue adding on here, coming back to Mike's earlier point, there's a bit of this, which is that communication with the client to begin with, because you do pay a cost whenever it comes to actually evaluating some of the ESG factors and a long-term deviation. We see that particularly pronounced in things where it is really focused on impact investing, where that's that prioritization of environmental or social outcomes over the overall investment return of a portfolio. But that's communication and clarity. That's making sure that a client understands what they're buying whenever they actually sign up for this product. So there's going to be a spectrum of deviation from a benchmark over time, depending on that very zeroed in outcome. And for some investors, that's okay. They want that. They want to prioritize that over a long-term investment return. But the truth of most investors, to Bob's point, is if you veer too far away from what the standard benchmark is, too far away from the peer group, they begin questioning their own commitment to that, because it actually is going to have a long-term impact on their overall total return.
Just one more thing related to that. I think importantly, you have to be able to explain where those deviations are occurring. So I might have a deviation in my two products simply because I made two bad investments in one and two good investments in the other. That's creating tracking error that has nothing to do with implementation of ESG, philosophy, process, or whatever. I just made two bad investments and two good investments. I may have deviation because I have some level of multicollinearity in a product. So most ESG products usually are higher quality products because people who report in ESG are usually higher quality companies. I don't know if it's chicken or egg. I don't know if they're higher quality because they report ESG or if they're better at ESG because they're higher quality, but there is an overlap there. And so if high quality is underperforming, it may not have anything to do with ESG. It may have to do with the quality of my portfolio. And so those tracking errors can exist over time. They just need to be explainable to the client at the end of the day.
All right, thank you for that. Now, with a little preamble for what may be our last question of the day, one of the things that has bothered me in this entire topic is something that was very colorfully explained in Liar's Poker, the first Michael Lewis book. When explaining to an investor a new concept, the investor had one question, which I can clean up by saying, how am I going to get hurt by this? I think the Jesuits wouldn't really appreciate the exact quote. So this is a question I asked on our preparation call, which we were given 45 minutes. It's also the only question I asked on our preparation call because of the fact that it took up 45 minutes. So I'm going to start, Glenn, with you since you've been very patient waiting. Can you help us understand for the skeptics of the world, all of whom seem to enjoy a spot at the editorial board at the Wall Street Journal, how exactly would you address the skeptic as it relates to ESG investing?
There's sort of two answers. There's the answer for the true believer, and then there's the answer for most of the public. And I'm actually going to give that one, which is ESG is not going to go away. The first ESG fund was launched 50 years ago, 1971. I'm older than that, but barely. But 1971, Pax World came out with the first fund focused on the Vietnam War and avoiding companies that were funded there. So 5 decades later, we find that we're at a point where ESG, the aggregation of awareness, is at a level where most investors know that it's an option. That means it's a trend. That means it's a macro trend. And the background behind that, it's not just about ESG labeling ESG products. The world is changing. And ESG investing, when we talk about integration as opposed to product, when we talk about integration, that has to be a fundamental part of the way an analyst and a portfolio manager looks at the world. There will be winners and losers over the next 3 to 4 decades. There will be winners or losers on ESG over the next 3 to 4 years. There will be winners over the next 3 to 4 months. This is a long-term movement in the way that the market is considering some of these issues. It is going to move much slower than some of the very optimistic, passionate people want it to be, but it will move nonetheless. If we think about in the UK as an example, back in the early 70s, they moved away from town gas, from coal gas, in the way that they were heating their homes to using natural gas, which burned cleaner and more efficiently. It took 7 years for that to happen. So we're looking at an entire ecosystem of energy transition globally, which will take much longer than 7 years. But that 7-year period in the UK had winners and losers. There were investments that at the end of 7 years were much stronger valued than they were 7 years before, and then there were money that was lost during that time. So as an investor, what I tell you is if you're not thinking about this, you're probably not, and if your portfolio manager, your advisor you're working with is not thinking about it, you're missing out on opportunity for growth, opportunity for performance, opportunity to take advantage of macro trends over time that will result in a better positioning 10, 15 years from now.
All right, Bob, I'm going to come back to you with the same question. And if there is a slight variance as it relates to the fixed income investment as opposed to equity, now's your opportunity to maybe split that hair if that's possible, or maybe you want to address it at a higher level.
The similarities are that, return is return is return. I think the trouble that we face in the ESG world is a very bifurcated decision process. That double bottom line also means that I have to be accountable to it in terms of my performance. So the attribution analysis becomes extremely important because I may have the most graceful, beautiful, gorgeous ESG portfolio in terms of hitting all the numbers compared to what's out there in terms of the various different indexes or things that I want to express in my portfolio. But boy, do I stink at picking the right maturities, the right duration, the right industry weights, and so forth. I really stink at that. But you know what's going to happen? ESG is going to get a black eye as a result of that. And I think that's where the attribution, the separation has to come in. They have to be mutually complementary. I think to Leo's point, most ESG companies are at the high end of the credit spectrum in terms of where do they naturally sit. Doesn't mean that they're all beautiful. There are some that are fundamentally troubled. They're good ESG companies, but their credit management skills is a little bit lacking. But I think these are things that we, as managers, have to be able to express and say, look, we're really good as a bond manager, and we're even as good, if not better, as an ESG manager. And put those two together, and you've got the right combo. You separate those two out, and you're going to find, and this is where you have to read the label and do the fine print kind of analysis and so forth. This is where I think attribution analysis fails us a lot in ESG. In that, you like to say, well, that ESG, really wasn't very worthwhile. Well, maybe they did do the right things from an ESG perspective in terms of what am I judging them on, but they just weren't very good stock pickers or very good bond pickers. That can happen. And so those are things, and that's where you start to look at the other non-ESG product and say, were they as stinky at picking bonds in a conventional product as here? Here's the other thing. If you're not so good in the conventional product, why being ESG makes you all of a sudden an angel? I don't understand that, but that happens so often, it's indescribable. And so I'm sitting here saying, ESG is creating its own problem unless we demand more of our analysis in terms of third parties who are scrutinizing us. And those are the things that I think are important. And it doesn't just mean, here's my Globe score in Morningstar. That's an easy, off-the-cuff. It has to go deeper than that. And I think those are things that are still missing in the due diligence process that we really need to work on.
I'm tempted to ask you to name names, but before I do that, I'm going to move over to Leo and see if you'd like to add something to that as well.
I think Bob and Glenn covered it perfectly. I think the only thing I would add is you can get screwed in the ways you can always get screwed, which is you fall for the marketing and not for the process. And I think there are a lot of folks who have made announcements and initiatives that are marketing. They're gathering a lot of assets based on that marketing, but they don't have a process in place to back up that marketing. And maybe those investors will get good returns, maybe they won't. But at the end of the day, they don't have a product that aligns with the values that they aspire to have in an ESG product.
So is there something I can look at as a naive investor to be able to separate the marketing from the process?
It's really difficult as a naive investor. You really need to interview and talk to management. You need to have consistency of data that allows you to compare apples to apples, one fund versus the other. I mean, you do have, stuff like Morningstar with their Globe strategy and that sort of thing. And, maybe that gets you part of the way there, but you need a consistent mechanism in place so that you can really separate the wheat from the shaft.
You hit the nail on the head. I mean, you can buy scores all over the place. Do you realize that the top 25 ETFs in today's market in the equity world are fueled by one single data source? It's called MSCI. Isn't that what diversification is all about? There's no diversification of view if that's your primary source for what the value of a company is from an ESG perspective. I, for one, would ask, Show me your research. Show me your independent research. Show me what you have written. Show me your opinion. Show me how that has changed over time. Show me that you've done your homework, not just your marketing. That's the important distinction. I think Leo makes an excellent point. That's where the rubber meets the road. Are these guys pretenders, or are they really practitioners? And I think that practitioner question really comes through in terms of the independent research, the way they think, the way they set things up. Let's talk about frameworks. Tell me about your framework. How does it boil it down? How do you look at the G? What are the things that you look at in G? Those are great questions. They should be rattling those things off. Not going to happen. And most of the marketing stuff out there doesn't ever happen. Great pictures, though.
The problem you have, though, when you look at that, if your question was, how does the naive investor or the regular investor avoid these problems, all right? And they don't have access to a lot of that. And you look at it, and even right now, you back up and you say, look in the last 6 months at the plethora of products that have come out that are ESG products, that are run by firms that have marginal track records running conventional products, okay? And so when you look at the comments and listen to all the comments, it's a trend. It is a trend. And when you look at products coming out by the day by people who have never done this before, or just throwing a name on it, or making promises that they're going to meet all the UN SDG by 2030 in their product, I mean, crazy promises. All right. That's when I go back to the comment that was made earlier. You can always get burned on a product. I think the idea of, though, having ESG integrated in your portfolio is a very sustainable and a very realistic way of approaching this, as opposed to trying to get the product of the day. You mean because I had the all-windmill portfolio, it didn't work that day? That's where you back up and you say to yourself, what are we looking at here? Is it a product or is it a process?
Okay, well, I recall my early days as a naive investor, and real estate investment trusts were the rage at the time, so maybe I just dated myself, but I was told early on, if on page 2 there's a picture of a swimming pool, you can put it down and it's a marketing. I was hoping for some sort of a response like that, but I guess we haven't quite found that commonality in
So
that.
did you buy it?
I ran.
On page 2, what you need to see is a crappy apartment building, and then you know it's a real REIT.
Indeed. Well, I think we're on time because I see in the back of the room I'm getting those. So unless anybody has any parting thoughts they'd like to point out, well, then I'm going to thank each and every one of you. Before this started, I didn't know any of you. I've had a great time getting to know a little bit more about you. I promised Katie this was going to get a little bit, I saved that one for the end because I knew we were going to get to there. And I do want to thank you, Chris, for inviting me to be here. I feel like a stranger in a strange land, but I feel very welcome. Thank you.